This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Hi, thanks for joining us. My name is Bruce Norris, and today, once again, our special guest is Robert Kleinhenz. The recovery has actually been surprising to me how well we've recovered, but I know that you're aware it's not been an even sum game. There's been some sectors that have come back and there's others that really have not. So can you give us a little bit of update on, the things that are coming back well and the things that are still lagging?
Yeah, I think that a lot of analysts, especially those who are in the financial markets, have been exceedingly optimistic about their expectation for the pace of recovery. If you take a look at the job gains that we have seen, even the most recent job gain for the nation last month, where we added like 266,000 jobs month over month, that far exceeds the average job gain that occurred as we were coming out of the Great Recession. And I try to look at this issue from the perspective of the business person and the consumer. Yeah, we've heard that the economy is reopening, but we're still not completely in the clear. And when that's the case, people are step forward in that uncertain situation, and they do so with a certain amount of caution. So I think we're looking at we should be looking for much more moderate gains over the next several months, and we will indeed recover the jobs that were lost there were 22 million jobs lost during the pandemic shutdown last spring. And we've recovered nationally all but about 8 million thus far. So we still have a ways to go, and we'll recover those, but it's going to take time. As will economic recovery in terms of activity. But by the end of this quarter, we'll recover all the lost economic activity that occurred during that time period in the first half of last year. A lot of people don't realize this, but the economy turned around in the second half of last year. So even though we had the largest economic downturn, a contraction of 3.5%, the largest since the 1940s in annual terms, all of that was front-loaded in the first half of the year. And the economy recovered or began its recovery in the second half of the year. These are all good signs. And I think that as we're looking through this year, we'll see that the unemployment rate is going to come down, but slowly. There are a lot of moving parts. There are a lot of irregularities right now, just because the people are still trying to figure out which end is up. So I'm not sure if I answered your question. Well,
let me ask you one other part to it. Have the higher priced or higher paying jobs recovered better than the lower ones?
Okay, and I apologize for overlooking that. So what's happened is you take a look. There's good data out there that tell us that, for all intents and purposes, the higher wage occupations and workers have fully recovered any job losses that occurred during the shutdown and the months following. There are lingering job losses among lower wage occupations, but it's really important to know at this point in time that the big problem is in leisure and hospitality. So we're talking about restaurants, and we're also talking about the entertainment industry, as well as tourism, so hotels and entertainment venues. The lion's share of the jobs that we need to recover fall in that industry, that major industry, leisure and hospitality. If we were to give every restaurant worker a job tomorrow, the unemployment rate in the nation would fall from 6% to 5%. That's how big the gap is right now. The other industries are coming back at their own pace, and that's good. But when you take a look at these stories about people that K-shaped recovery, the high-income households have fared well and they're doing fine. The lower-income households have fared poorly. Many of those lower-income households are in leisure and hospitality, so restaurants and so on, or in other services. Those are also industries that have high concentrations of small businesses. So you have heard throughout the last 15 months about the pain that small businesses have been going through. And so all of those problems are really concentrated in those two industries. If we get those two industries back on their feet fully, and it's going to take time, but once we do so, those low-wage workers are going to see recovery. The other piece of with all this as well is the fact that with kids having to go home or stay at home over the last several months, at least one of the household members has had to stay at home. In many cases, it's been the female household member, so the mom. And so this has turned out to be a she-cession in the sense that many of these trends have adversely affected women more than men.
Okay.
Bruce, yeah, something came to mind is if that's the industry that you see needs to recover the most, how did the state's individual reactions to, shutdowns and closing down businesses, are certain states well ahead of California because we were one of the more stricter of the shutdown states?
Yeah, I think we need to weigh both the health and the economic aspects of these different approaches to dealing with, the health concerns associated with the pandemic. There is some research that shows that while we may have been more restrictive and we're more restrictive for a longer period of time than some of the other states which reopened. I mean, some of them reopened at least partially, if not much more fully, a few months ago. And here we are in California talking about June 15th, which is still 2 weeks off. The evidence, especially based on the research that was done on the 1918 influenza pandemic, shows that the long-term growth prospects for the more restrictive, for those regions of the country that implemented more restrictive health protocols, the long-term growth prospects are better. Okay. So it's important to keep that in mind. And it's not like I'm a champion for restrictive health measures by any means or hobbling the economy. I'm just saying that it appears as though that type of outcome occurred 100 years ago. And unfortunately or fortunately, that's, where we have to turn to learn lessons going forward. About
we don't have one of those every 10 years.
Yeah.
Okay.
So
what's the GDP growth likely to be in 2021, do you think?
2021 GDP growth is probably going to be in the high single digits. Okay. So we're talking about somewhere between 6.5% and 8% growth this year, which would be the fastest pace of, that's for all of this year. So for the first quarter, we've already got a 6.4% growth rate. And for the second quarter, I think we're looking at 11%, something like that. But so this is going to be the fastest annual growth rate we've seen since the 1980s. And even next year, we're anticipating that economic growth is going to be far above the trend that we've been accustomed to, which is in the neighborhood of 2 to 2.5%, maybe about 5% in 2022.
Okay, so in 1983, that was the last year we had something that was in that range. Now, what's interesting is the interest rates difference. So Fed fund rate is 0.25% right now. Fed fund rate back then was 10. And mortgage rates are 3 and they were 12. So I guess, what's your opinion of why the stark difference? It seems like, is our GDP growth forced this time rather than natural? In other words, I guess I'm trying to figure out why the big policy difference. They're not trying to prevent inflation yet. I think they're trying to prevent deflation.
We do need to keep in mind that these programs, especially the fiscal policy efforts on the part of Congress and the White House, are generally spread out over several quarters. So even though we're talking about big numbers in the trillions of dollars, they are spread out over several quarters and maybe a couple of years. And so there's no doubt that they have big impacts on the economy. But we need to keep in mind that the private sector of the economy in the United States is by far the largest sector. I mean, you've got about 70 to 75% of economic activity, that is to say spending, happening just from the consumer sector alone.
Right.
And then you add in the private business sector, which accounts for maybe 15%. So the economic engine that we're looking at going forward is going to be pulled forward by private sector spending more so than the support that's been lent to it through these various public programs. And if we try to draw a comparison between today and back in the 1980s, the thing we need to keep in mind is the history immediately preceding each of these. In the early 1980s, we had a period of time in the 1970s that was marked by stagflation. So there was little or no economic growth. And at the same time, we had relatively high rates of inflation. That gave rise to what we economists call higher expected inflation. So people were building higher expectations for higher inflation into things like their asking wages for work and so on and so forth. You shift forward to where we are right now, and the immediate history or preceding history that we are coming out of has been one of very low inflation. In fact, it was the efforts in the 1980s on the part of the Fed Chair Paul Volcker to tamp those inflation expectations down that gave rise to really the last 25 years or so of very low inflation and very low expected inflation. So now the question is, what's going to happen to inflation expectations over the next few months and over the next few years? And to answer that question, we have to figure out whether or not people think that this near-term bump, it's not a spike, near-term bump in inflation, whether that's going to be sustained or if it's going to be temporary. Most of the signs are pointing to it being temporary rather than sustained. And if that's the case, then inflation expectations aren't going to change a whole lot. And so in all likelihood, inflation, a year from now is probably going to be in the low single digits, maybe in the neighborhood of 2.5% to 3%, similar to what we've been experiencing. That's the high end of what we've been experiencing over the last several years.
That's really interesting. So the elements that came about, let's say, I mean, I was fortunate in the 70s. I got married in 1970, and I owned a home first probably in 1973. Well, that's right at the beginning of a chart that goes straight up in price for California real estate. And so it was interesting what you said. The expectation was that your wages were going to go up and your prices were going to go up.
Yeah.
But so that expectation is almost more important than the result. Is that kind of accurate?
Yeah. If expectations if expectations for inflation begin to rise, then people so households and businesses are going to build that into their future decisions. And that can be a self-sustaining problem. And in turn, a self-fulfilling prophecy, if you will, that will drive higher actual inflation. But in this environment, it's very unlikely. We have a lot of slack. We're hearing about, the lumber prices that have quadrupled and all that kind of stuff. Again, the question is, are these temporary disruptions in the supply chain that will eventually be remedied, or is this a sign of something that's going to be around for a long time? And what I'm hearing is that many of the higher prices, whether we're talking about it on the production side or on the consumer side, many of these higher prices are due to what are probably going to be temporary problems that will eventually get worked out over time.
When we're talking about pricing in the supply chain, be it lumber, PVC, or anything else that has seen a huge increase, will these prices come back down to normal pre-pandemic rates, or will industries try to make up some of the losses, or even just see it as an opportunity to keep some of this inflated rate?
That's a great question. It really depends on the presence of competition in these industries. This is Econ 101 at its best. We take a look at the markets out there, and in many commodities markets like wood, it's a global market. Even if there are a handful of producers, they often tend to be in competition with each other, and that competition over time is likely to drive those prices back down to close to where they were before. Because the presence of those other sellers is going to keep them from achieving much more than what economists call a normal markup. And so it really depends on which industry and what kind of barriers to entry there are, and whether or not those barriers to entry or the presence of other competitors is either, if there are a lot of them, then that competition, drives prices back down to where they were before, plus or minus. And if there are not a lot of them, then there are opportunities to hang on to more profits. So this whole thing with the silicon chips and automobiles,
Right.
The fact of the matter is that many automakers relied on just a couple of firms to produce those silicon chips. So those firms had a lot of so-called monopoly power, and that also, so I mean, so even though it's high tech and it's large scale production, I think there are opportunities globally for that particular industry to respond to the shortage, and this created a huge opportunity for that to occur. It's just a question of whether or not the automakers globally are going to, look to other producers. And we've seen this also with airbags, right? Was it the Tanaka, or I forget what the name of the airbag company was, that pretty much served the majority of the automakers around the globe. And when their airbags had defects, it sent the automakers looking elsewhere for other producers. So I know I'm rambling a little bit, but you really want to look at at the extent to which there are a lot of sellers in those industries. And if there are a lot of sellers in the industry, there's a good chance that the prices are going to return to very close to where they were before.
What are the elements or the drivers of deflation? What are the things that you say, okay, wow, like Japan, Japan's sort of a prototype of what happened with demographics.
Yeah.
And a lot of their efforts on lowering interest rates, it's turned out to prevent deflation, but it hasn't boosted the inflation side. So what are some of the elements of deflation that you look at and say, okay, those are issues or they're not issues?
I think the thing that we have right before our eyes, but we overlook all the time, is the influence of technology and the productivity gains that arise because of technological advances that also translate into little or no inflation, or maybe even deflate or lower prices in some areas.
Yeah.
So that's a huge driver, if you will, behind whether it's deflation or at least keeping inflation low. And that's one of the things that I'm counting on going forward. Technology, we think back over the last 40 years, the personal computer was, introduced, or at least the IBM PC was introduced in 1981. And you would think, we've, seen so many technological advances over the last 40 years, but clearly there are still many more to come, more on the software side and on the artificial intelligence side and so on than on the hardware side. But those kinds of phenomena and their impact on our everyday lives are also having a material impact on where prices are going. So if you want to look for areas where prices are likely to go up, you look for scarcity. So real estate, of course, is an area where fundamentally there's only so much land in California, only so much land in metro areas around the country. So real estate long term is always going to be an area where there's great potential for price appreciation. But you look at other aspects of our economy, as we're more service-based and tech-based, information-based, these are areas that are not likely to show a lot of inflation going forward, or price increases. Inflation is the more general term that refers to the general price level.
How do our demographics favor either inflation or deflation?
I suppose it's an interesting question. I think our demographics probably favor little or no inflation at the present time. The most important thing here is as opposed to population, it's maybe per or even GDP, it's GDP per capita. So the livelihood, the well-being of the individual in our country, as long as GDP or personal income per capita are on the rise, then we would expect to see consumer spending increase, the associated activity on the business side of things, all of which I would think ought to temper the effects of deflation and tend to cause inflation to rise. Of course, the tempering effects of the sources of deflation, as I just said, are technology. So we've had a long run here where technology, I think, has been instrumental in keeping prices low. I think that's going to continue for quite some time. Now, as far as demographics are concerned, I would argue that nationally as well as statewide, we would at some point benefit from taking a good hard look at immigration and immigration policy. It's been an important source. Immigration has been an important source of population growth, as well as gains in our labor force and entrepreneurship over the last, well, who knows how long, decades, if not centuries. And every 30 or 40 years, we need to retool our immigration policy. And I think we're overdue for that.
Yeah, I agree. I think that would be nice to get behind us, instead of being a point of contention, comes to some reasonable across the table agreement and have a lot more people be citizens. And I don't think anybody on like if you say, okay, we wish all the people that were not here legally would leave. No, you probably don't. That's probably a big mistake, So, but I understand that there has to be restrictions in entry too, but we better deal with, I don't know how many people are here that are here illegally. I don't have a clue. A lot.
Well, I think it's maybe in a high single-digit percentage of this national population. I think it might be a higher percentage of the statewide population in California.
Okay,
but I don't have the exact numbers.
Yeah,
but it's clearly something that we need to address. And for every study or every report that shows that or that claims that immigrants are the source of all the problems that we have, there are several reports, good research that show that they make positive economic contributions. They take the jobs that Americans don't otherwise want to take on, and they're a huge source of entrepreneurship, which, again, we have a higher concentration of immigrants here in California, and many of those companies, those high-flying companies, we either founded or have been operated or have had CEOs who are not American, born here in the United States, but are international individuals who decided to make California their home.
Great point. As far as debt levels for the country, so we've added a lot to the debt levels. In a report that I wrote in 2017, I think, I mentioned I thought we'd have interest rates that would start with a 2 and we'd get to 40 trillion in debt. So unfortunately, it looks like both of those are going to be accurate. At what point does the debt start impeding GDP growth?
I would say that the thing to look for, so I'm not a public finance expert, so I just want to make that clear, but the thing to look for in my observation is the extent to which our debt service as a share of GDP,
right,
and our debt service as a component of our federal budget gets to be so large that it's genuinely detracting from meeting the needs of the community. I mean, that's a problem in local government when we talk about pensions, right?
Sure. Absolutely.
So cities are having a hard time delivering public services, public safety and the like, because they've got such a high pension obligation to their current and future workforce. Their current and past workforce. So they've got these obligations. So I think if we view it through that same lens, the real concern, in my view, is the fact that at some point the service costs of carrying that debt can really interfere with the federal government's ability to meet the needs of our residents and citizenry. I don't think that's a problem right now. I don't want to say it can always print money. Really, it can always go into more debt is what it can do. And just to be clear, most of that debt is held by us. It's held by residents of the United States, whether it's individuals or firms or the other government entities. Somewhere in the neighborhood of 70% or so of national debt is held by Americans, and about 30% is held by countries abroad.
You made an interesting point. So you did say it can always create more money or liquidity. Can it always control interest rates?
That's a great question. In the 1970s, the Fed was on top of the world, and at that time, it really could control interest rates, especially here in the United States. Between the 1980s and 2021, where we are right now, the world changed dramatically in a lot of ways, one of which is that the financial system became a global financial system, right? And so now the Fed can control certain key interest rates or policy rates, like the Fed funds rate that establishes a floor for short-term rates. But when we talk about things like the 10-year treasuries, or we talk more generally about interest rates, right now it doesn't really have the ability to control rates so much as to influence the direction of interest rates.
Okay.
Because it's one of many central banks, and it's in a global financial market where there's liquidity all around the globe that is seeking return. So the Fed can't really control interest rates the way it used to. We're very lucky in the United States that we continue to have that the world views the dollar as the reserve currency. And
I was going to get to that question.
Yeah.
Does that get threatened by debt levels?
That's a great question. We're also a safe haven.
Yeah.
So we've got two aces in our hand that a lot of other countries don't have. So even when things aren't going so well for the United States, if things are worse around the world and there are heightened levels of uncertainty, money flows to the United States. Okay. So this issue about the national debt, I mean, I guess I should weigh in on this and say, I would argue that this is probably a centrist view from the economics profession. There are many different views on whether or not we should worry about the debt and the budget deficit. But I think that the idea ought to be that when the economy is doing well, the federal government ought to at least break even, if not run a surplus, and work off some of that debt, pay down some of that debt. When times are bad, so as we've gone through the year 2020 and into the first part of 2021, that's the time to engage in deficit spending, because the government does have the ability to generate spending through borrowing that would otherwise not be possible, and create a backstop to the economy when times are tough. So I think that's a way to look at both the deficit and the debt picture that I think is reasonable. So we would never necessarily be able to totally eliminate the national debt. Even corporations go into debt and carry debt on their books. So it's not like the government needs to have a totally balanced budget, nor does it necessarily be debt free. And there are a lot of reasons why the government, whether it's state, local, or federal, should run, or can and should go into debt. But there should be some sense that at some point you're trying to manage it. From what I've seen, neither political party has any interest in managing either the budget or the national debt at this point in time. Nobody seems to be interested in those things. That's a cause of concern.
Yeah. Last topic, tax law changes. So, series of things that have been brought up, probably, or some of them going to be enacted. So capital gains rate going up to the highest personal rate. What do you think the impact will be? Two things. on revenue. Do you think it'll actually raise tax money?
Yeah, I'm not a government finance or a tax expert. I tend not to assess proposed policy changes until there's a really clear sense that they're going to happen.
Okay.
And
the reason why, as a real estate investor, when you're thinking like 1031 exchanges, they're talking about getting rid of that.
Yeah.
Well, that would be a big change.
Yeah. I think when I look at it from the perspective of the last round of tax changes at the federal level, the 2017 tax changes in the tax code and so on, the coastal states, the high cost coastal states, in my view, were adversely affected by the limitation on state and local taxes and mortgage interest deductibility. So these kinds of changes in time do have an impact on investor decisions. There's no doubt about it, as they pivot and try to figure out a way to continue to protect their gains. So an increase in the capital gains tax is going to lead people to look for other ways to shelter their income. There's no doubt about it. There may be an interest in figuring out ways internationally to circumvent some of these, but I just feel like this is not my forte, Bruce. So I can talk in general terms, but
yeah, that's fine. No, that's okay. One last question about taxes. There's been bandied around California and at the U.S. level about a net worth tax every year. Do you have let's just say that something like that was implemented in California. What do you think the ramifications would be of that?
Yeah, I think that these kinds of measures are better addressed at the national level, so that it can create a even less even playing field if California implements a net worth tax, and that doesn't show up elsewhere. So we hear these high-profile individuals who are leaving California because they're seeking to avoid the high taxes of California. And mind you, when you take a look at the migration numbers, because there's still migration state to state, the people who are moving to California tend to be high-income, well-educated people, right?
Yes.
So it's not exactly a deterrent. A couple of things that I think I just want to mention. One, for the state of California, we kind of need to have a total overhaul of our tax code, property tax, income tax, state and local tax. It's just not working very well. And we've got all these different patches, but we're not really, I would argue, looking at and we also need to overhaul maybe our CEQA to make that less of a deterrent to real estate production.
Yeah.
So that's one thing.
Good luck with all that.
Yeah, thanks. But in order to increase housing production in a material way here in California, I think we're going to have to address some of that. But the other thing that I wanted to mention is that, we have seen over the last 30 or 40 years a shifting of the distribution of income toward, a higher concentration of higher income of income as well as wealth in the hands of a smaller number of higher income individuals. A lot of it has to do with what we talked about earlier, the upheaval that's brought on by changes due to technology. So when you have upheaval driven by technological changes, whether we're talking about the 21st century, we're talking about the early 20th century, capital tends to be the area that benefits the most. So investors and business people and so on. I think that's what's happening here and has been happening for the last 20 or 30 years at least. I think, there's an argument to be made to figure out a way to rebalance the distribution of income a little bit. Maybe rebalance isn't the word, but to shift it a little bit. But I'm not the tax expert, so I can't claim to have answers to that. I just see the symptom, which is a problem.
The society impact. I understand that. I really do. I had the privilege of meeting with the CEO of Fannie Mae in Washington, D.C. this last week. And the goal was to have him contemplate a nothing down loan program for first-time buyers, because that's one of the ways you feel like you're part of the game. Owning your own home is a big deal. At least it was to me. And so, gave him a program that I think wouldn't create foreclosures and would be beneficial in reaching across the aisle to the people that don't feel like they have a stake in the game. And I think that would be a good program.
I hear what you're saying, and I agree with you that, despite what we have read for many years, that millennials are different from their parents in terms of their buying habits and their preferences, and they may not be so inclined to become owners. They may want to rent through their entire lives. They may never want to move out to the suburbs. Well, all of those conjectures, I think, are proving to be wrong. As millennials move into the life portion of their lives where they're having unions. So we'll not necessarily talk about getting married, but having unions, having kids. They need space. They're moving to the suburbs, and they want to go to places where the schools are going to be good in the interest of their kids. So they're behaving a lot like previous generations behaved. And so I don't think there are any surprises. The thing about first-time homebuyer support that concerns me is that, and this is not just for the state, but nationally, if we're already dealing with huge housing shortfalls of supply relative to demand, this is just going to exacerbate the problem. So I think it's a laudable effort, but we really need to be looking at the other side of the market, not propping up, not trying to drive demand higher or create opportunities. I mean, the idea is to create opportunities for first-time home buyers that wouldn't otherwise be there. That's a great idea, but holy cow! And I know Fannie is not really in a position to change this a whole lot, but we really need to build more housing. We need to increase that supply, and it's evidence. The most significant piece of evidence is that we see these high home prices.
Absolutely,
rising home prices.
Well, what's interesting, what you just said, there's a chart that I paid attention to because of what was available from Cal Poly. They always charted the price of a new home versus existing home. And they only have inverted 4 times, 80, 89, 05, and December of 2020, where the existing home price was more than the new. And that's because of what you just said. The demand is so high, it can't land as often on a new home.
Yeah.
Is landing on an existing one, and prices just took off. So, Robert, I have enjoyed this very much.
It's great to see you, Bruce.
All right.
Say hi to Aaron as well. And thanks for running the show, Joey. It's good to see you. Good luck to you guys.
Okay. All right,
Thank
Robert.
Yeah.
See you soon.
Take care.
Bye-bye.
Bye.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.